Hey, what's going on, guys? This is Greg with Ideal Trading Ideas, and today is May 26, 2021. As you can see, we have Under Armour up on the screen. Current price is $21.39. We're up positive 10 cents or positive 0.47% over the past day. And we're just going to run through the charts real quick. 1 week chart, we're down 0.69 cents or negative 3.12% over the past week. 1 month chart down $2.07 or negative 8.84%. 3 month chart down 21 cents or negative 0.97% over the past 3 months. 1 month chart, we're up $12, or 1 year chart, I'm sorry, up $12.64 or positive 144.46% over the past year. 5 year chart, we're down $16.60 or negative 43.70%. As we scroll down, we see that we have upcoming activity. We put in for a UAA call credit spread, and it has been placed. As you can see, the status says placed, good for today, and we have a quantity of 2, and our limit price is 15 cents, right? And if we have 200 shares or 2 contracts, that's going to be $30 for us. So what we're going to do is get right into it. And as I scroll through, I'm just showing you the trade on my spreadsheet, and we have it right here. UAA, Under Armour call credit spread. It's a future trade because it hasn't actually went in because the market doesn't open, or the pre-market opens at 9 and the actual market opens at 9:30. So we have it to open and close on the same day. So we're going to try to do a day trade with it. 2 contracts, Greg, anywhere from $21.50 to $22. 50 cents times 200 shares or 2 contracts. We had to put a collateral up of $100. As you can see, we got the 0.5015 right there. $10 is what we're going to try to pay out, and we're going to try to come out the deal with a total of $20. So basically, when it goes through, they're going to give us $30 up front, and then we're saying, hey man, we're willing to sell it back to you for $10 so we can go ahead and lock in $20 of profit. So I'm basically just going to try to do a day trade, 1 day, get in, get out, and I'll possibly repeat the process tomorrow. But anyway, what I'm going to do is just click on our trading view chart to show you what I have mocked up. Red lines are our resistance lines, blue lines are our support lines, and like I always tell you, I like to do 52-week support and resistance lines because I want to know basically what's been going on with Under Armour over the past couple of years, right? So I haven't actually put in the names on the lines. I'll work on that later on, but we have went back to 2017, and we see that the high in 2017 is 31.08. The low is 11. Is it 11? Yeah, 11.39. We go over into 2018, and we have a high of about 24.97 with a low of 12.50. We go over to 2019, and we have a high of 27.76 and a low of 16.74. And then we go over to 2020. Obviously, when the pandemic started, we have a high of 21.39 and we have a low of 7.11. So anybody that got into Under Armour around this time and just held, hey, they're good to go. And we go into 2021, and we see that this is our high right around here, 26.49. And since the high, we've actually dropped down. Now, you have to understand that our resistance lines turn into support lines, as the price moves around, right? So these are long-term resistance lines. And as you can see, Under Armour has trickled down and went below the resistance area. So it didn't even use it as a support. It's a possibility now it's going to use it as a resistance, and Under Armour could trickle down. We have short-term support and resistance areas that take place. I don't have them mocked up on the screen, but you can pretty much kind of take a look and say, hey man, anywhere from here down to here is probably going to be a support. It shows it right around here. So if we do look at our long-term support, 16.74, it's a possibility we're going to see Under Armour trickle down as the weeks go on and possibly get close to that 16.74 range. But if we had to think about it for the next couple of days, it'll probably go as low as 20.65. So it's a possibility it can go even lower. We're going to bank on that, and that's the reason why we're doing that trade. So what I'm going to do is go back to Robinhood, and I'm going to show you how to do this call credit spread. First thing you want to do is click on trade UAA options, and as you can see, we have Under Armour in front of us. It says buy, sell, call, put, and we have the buy click and we have the call click, right? So just move up just a little bit. We're going to look at the $22 strike price, and we're going to just click right here on the 11 cent. And as you can see, it says long call, 22 call, and it's 11 cents. So basically the total cost is going to be 11 cents for 100 shares, which is one contract, which is $11, right? Then you're going to want to come over here and click on sell call and change that to the 21.50 strike price and just click right here. So now what you have is a credit of $25. When you minus those, add those together or minus them out, you come out with a total of 14 cents. Now we can scroll down and it gives you a quick expected profit and loss calculation. This is something Robinhood has added to the mix. And as of right now, you would have an expected profit of $15. That's at the max. If you did one contract, they're going to go ahead and give you that money up front. And as you can see right here at 21.65 is your break even mark. So if you are in this particular call credit spread, and if the contract expires and you're right at 21.65, it'll expire worthless. You'll get your original $50 back, and that $15, that $14 that they gave you, you would keep. Now, if it happens to travel up, the max you could get is the $15. So if it travels down, if it travels down in price, the max that you're going to get is the $15 that they gave you. You can obviously decide to kind of let it go. Like I said, if it drops down further in price, you can keep some of that money. As you can see, 21.55, anywhere around that range, you can kind of lock in some profits. But if it goes above 21.65, you see at the very top right here, that 15 starts changing. So if it starts going up in value, 21.86, 87, the max that you can lose is $35 on this particular deal. If it goes up to 22, it doesn't matter if it continues to go further up. The max that you can lose on this call credit spread is $35. So this is one of the reasons why we decided just to do it for one day. Try to do a quick day trade with it. And one of the reasons, because we're already in the positive when it comes to this, so we believe it's going to drop down slightly, and we'll be able to get out by offering back $10 on the deal, locking in 20 and keep it moving. So that's pretty much how you would go through this particular deal. You would click on continue, contracts, 100 shares each. You would just type in 1. As you can see, the limit price is 15. So you want it to, you can put in 0.15, minimum credit of $15. Click on review, and it's showing you that, hey, they're going to give you a $15 minimum credit, and it's going to cost you $50 in collateral. Now, if you decided to change this, you can change it to 2, 3, 4, whatever it is. But when you do that, the amount of money that you're putting up for collateral is going to change. So if you go 2 contracts, it's going to be $100 in collateral, like I have on my spreadsheet right here, right? $100 in collateral, because I'm doing 2 contracts. Going back, if you decide to do 4 contracts, then you're putting up $400 in collateral. Now you're going to get more money in terms of the deal. 2 contracts will be $30. 4 contracts would be $60, right? So it's up to you on how you choose to go. From there, you're just going to click on submit. It'll go through when the market opens. As of right now, it's 8:40 in the morning, so we still have a little bit of time. So I'll let you guys know how this goes. Anyway, hopefully you guys learned something about call credit spreads, how to put them in, and whether or not you would like to do that. Remember to like, subscribe, comment on the channel. I'm going to continue to drop these videos. Have a great day.